everybody, and welcome. It's really great for you to be joining us here today. We really appreciate you taking the time. I'd like to begin by acknowledging the traditional owners of the land, probably the many lands upon which we meet, and pay my respects to elders past, present and future. We've got a large number of people joining us today, and we've got a fabulous panel lined up to explore the topic of whether we should be investing or not to investing. And I know that we've got a lot of really interested investors on the line, as well as a number of startups that want to hear whether they've got some cash to be invested in their companies. We've brought this event together at the suggestion of one of our panelists, Ariane Barker, and I really want to thank Ariane. We had a great discussion a couple of weeks ago and compared notes on the discussion of whether people are thinking about investing or not to investing. And I think it's fair to say that the views are wildly varying. And we recognize that investing is something that is deeply personal. And there are people who are very bullish right now, and there are people who are really conservative. I think it's fair to say that our panelists probably don't fit at those extremes, but they certainly have a range of views across the middle, and we're looking forward to exploring that today. We really want to unpack it. I think we've heard a lot from the VC sector about where their heads are at, but I don't think there's been enough said to date about where angels are at. And yet we know that angel investing is so fundamental to our ecosystem. So we've assembled a panel of 4 experienced angel investors. All 4 of these people make investments on a regular basis, but they also have day jobs. And Ariane Barker, I mentioned a moment ago, is the CEO of Scale Angels. Rachel Neumann is head of startups for Australia, New Zealand, Amazon Web Services. Ed Hooper is an investor, but also at Cardinia Ventures and co-founder of Omni Studio. And Quentin Wallace is managing director of Brett Ventures. Before I start, I just want to touch on a couple of housekeeping points. I'm sure many of you have attended hundreds of these webinars by now. I'm sure you know the drill. The Q&A channel is the best place to post your questions. Chat is where you can reach out to each other. Please do send your questions through, and I'll do the best as a moderator to weave your questions in throughout the discussion today. So without further ado, let's get started. And I think to begin with, I'm going to throw my very first question to Ariane. When we spoke a couple of weeks ago, Ariane brought a lot of perspectives to the table. But one of the things that really caught my attention was that she spent time in Hong Kong in lockdown, as I understand, during the SARS epidemic. And I think her experience is really relevant to where we're at. So I actually thought, Ariane, if you could start off by telling us about your experiences during that crisis, and also how does that then bring to bear in where we find ourselves today, and how are you thinking about, what do you think about the angel investment community right now?
Sure, and thank you very much, Kate. Great to see everyone on the panel, and thanks for bringing this together so efficiently in what is a very challenging period for all of us at the community level, at the industry level, globally. I cannot believe that it's almost takes a significant event to bring everybody together in such a cohesive way. So, yes, I was struck when we first started going into quarantine about the similarities with my experience in SARS. For me, SARS in Hong Kong was a really pivotal time in my life at the personal and professional level. I was working, setting up the hedge fund business for Goldman Sachs in Asia. Hedge fund and the alternative asset industry was growing massively in Asia in the early 2000s. I was also pregnant with my second daughter, and my whole family was asking me why the hell was I staying in Hong Kong when I had a toddler who was 1.5 and I was pregnant with my second child. So being torn between my family members in Australia and in France, I decided to stay put. My husband was there, my job was there, there was some interesting work to be done, but we were definitely in lockdown. And so walking around the streets and seeing everybody in the face masks and seeing the way that the market responded was really interesting. But I had also had the benefit of the backdrop of the dot-com bubble in the late 90s and the World Trade Center bombing in 2001, when I was also having just given birth to my older daughter. So I'd sort of been through market volatility before, and my background, so the relevance to all this is that I've always worked in financial services and largely in investment banking, having started my career in Merrill Lynch and then Hong Kong, and then Goldman Sachs in New York, London, Tokyo, Hong Kong. So having worked in markets in these times of volatility, in my early years when I was in my 20s and we experienced the dot-com bubble, I was really struck by valuations and the way that the traders and the deals that we're working on in capital markets team were impacted, the valuations that were taking place, almost the frenetic energy with a backdrop of some really cool people looking at valuations quite forensically and looking at data very, very technically. And that is my personal inclination, which is get the data and actually work through the problem. But when you have that happening with the backdrop of all of this volatility, when I first experienced that, it was quite an emotional roller coaster. But through SARS, I kind of got that perspective where you actually go back to your core skill base and you look at valuations. So I know we're going to get into a conversation about whether to invest or not to invest, and I'll question in my own way shortly, but hopefully that gives a bit of perspective of the volatility that I've experienced in my career, and having worked on it from the investment banking capital market side of the desk, I'm acutely aware of how valuations and earnings get impacted.
Fantastic. Thank you, Ariane. So Rachel, what are your thoughts on the pandemic? Where are we at, and how do you think this is affecting the angel investor community?
Yeah, Kate, thanks so much for having me join today. Listen, it's really hard to look into the crystal ball, I think, because, you know, we have examples like SARS, like the GFC, like the dot-com bubble, but there really is no playbook for what's happening right now. So it's really hard to predict. And, you know, as everyone knows, just information is changing on a day-to-day basis. So it's really hard for us to kind of look ahead. I can tell you what I'm seeing personally, myself as an investor and with working with other angels. And that is, angel investors fall into a few different flavors. And there's some of those flavors that are going to be taking a step out of startup investing right now. And if we think about who those are, that's, you know, people who maybe a couple months ago had a little bit of extra capital that they wanted to, you know, startups are super exciting space to invest in. They started to show some interest, want to dip their toes in. And right now, given the volatility and given some uncertainty around their personal future or what might happen, they're maybe just taking that toe out of the water and not taking the plunge right now. There are other investors whose investable capital were, you know, proceeds from their primary business or from the public markets that have taken a hit. And so right now they might be focused, either that capital is no longer available or they're focused on kind of getting those parts of their portfolio under control. So I think that, you know, those flavors might have, you know, shifted outside of the investing space. And then, you know, the reality is there are some investors that see that the real opportunity right now is in distressed equities markets, where you can get stocks that are much lower than they have been previously, and it's a more liquid market, so they see that's attractive. That said, there are a bunch of angel investors, you know, me included, that are still going to invest in this space. We believe very strongly in startups, both as an asset class and as a driver of our future economy, and we're going to look to continue to invest during this time. That said, I have to be really honest, in the last 5 weeks, which, gosh, has felt like years, I have gotten a lot of inbound emails, as I typically do, of great early stage companies looking for investment. And it's not that I'm not investing, it's just that I'm not opening those emails because my time and attention is really focused on the founders in my existing portfolios and helping them to stabilize their business and think about managing through this time. So, you know, that might change, right? Like as the leaders of those businesses kind of get a handle, they start to think about their cash, their team, they're thinking about their scenario planning, and I'm helping them, you know, in my small way, guide through that. Maybe then I'll have some spare headspace and capacity to think about investing again. But right now, it's not for lack of investment appetite, but it is for lack of time and headspace. I really am focused on supporting my existing portfolio during this time.
Thanks, Rachel, and really interesting perspective there. So Ed and Quentin, I'm really interested in your views on the current market and where we're at. Let's throw to Quentin first. What do you think is happening to the angel investor community?
Well, as Rachel said before, there's quite a variety of different angels, and it'll be about their personal circumstances. If they're fully invested in the market and they don't have excess capital, they'll probably withdraw. Some people have had big exits from, you know, businesses that they've had, personal businesses they've had, and they may be sitting on a lot of capital that hasn't been deployed into public markets. So they may be more active into, you know, startups and other areas, which they say is long-term investments. So there's a wide range. On a personal perspective, very similar to Rachel as well, in terms of trying to help the companies that I am currently invested with, but obviously looking at anything that comes along. As we've seen from the recent, you know, later stage deals that have happened, Safety Culture, Airwallex, Fast, these sort of deals, good companies and good founder sets will get funded. There will be capital there. It's just that it won't be at the heady valuations that we've seen recently. I think they'll take a haircut because while public and private markets are different, they still are related, because you still have the opportunity to use that capital in a public market or a private market. And a lot of people are now seeing what were, you know, vastly overpriced assets in public markets as good buys. And so they'll be maybe shifting some of their money from the private market to public market.
Thank you. And Ed, what about you? What are your views?
Yeah, look, similar to the rest of the group, the fund that I run, has a lot of people that have put money in. And since the crisis kind of started, you know, besides working with the existing portfolio to kind of weather the storm, I've been speaking to a lot of those folks and just other kind of, I guess, angels that I've invested with in the past, and just seeing, the really different mindsets has been pretty crazy. I've literally had some people call me up and say, hey, you know, what deals have you got? Because, you know, valuations are going to be amazing over the next 12 to 18 months. Like, I want to double or triple what I was spending. But then there have been a lot who, as others said, like, hey, you know what, my business is in trouble and I just need to put my attention there because there's people's jobs on the line and there's kind of other things. I think in the upper end of town around venture, a lot of these funds have already raised a ton of money. So they've still got a lot of cash to spend over the next few years. Because I think with the angel side, definitely people can just kind of like switch it off pretty easily. And so I think there's definitely a lot of folks that are kind of over the last 5 weeks have been getting their house in order. And the sooner that can be done, the more people should be jumping back into this. So I think it's going to get better over time. But I guess the message that I've been personally communicating is, hey, we're open for business. The bar's probably a little bit higher because of Corona. And we want to find out, you know, how are you impacted? And, you know, what are you doing about that? And there's definitely some businesses that have appeared, and because of Corona, they're actually doing a lot better and they actually need capital now and they're pretty attractive. And so I just say to all the founders out there, like, definitely try and get money. There's definitely people out there, but just be really honest about where you are and kind of how you're affected by this.
So thanks, Ed. That's great. And one of the things that I've spent a lot of time talking to people over the last few weeks, and certainly when I talk to startups, it's there's a lot of understandably really negative sentiments coming forward, some concerns that they may not get funding. And we've certainly seen that in the press as well, that there's going to be a reduction in funding. But I believe all four of you have been looking at deals in the last week under different circumstances. Rachel, I'm going to throw to you first, because you've probably got the most interesting case study about the deal that you've been vetting recently, and what, you know, this happened right at the cusp of Corona, and how did your investment thesis change, and what did you do as you were managing vetting a deal during the last 4 weeks?
Yeah. So I'm not going to say the specific deal just because I don't think it's made public yet. Yeah. But I did do, my last investment was through Eleanor Ventures, which is a syndicate run by Kylie Fraser, who's amazing. And the one thing that you should know is that the DD for that deal did precede the current crisis. And so just a note of I don't know, warning, but just to, you know, for folks out there who are going to see announcements of funding that are happening, you know, in the last few weeks, just know that chances are those deals have probably been in pipeline for at least 3 months. So not to put a gloom and doom, you know, cast over everything, but don't take funding announcements as a sign that like everyone is out there running deals now. Some of these things take time. So I will say that, you know, in this instance, we had committed to the deal before everything, And I think that as the crisis started to unfold, there was a moment where we had to, really think about whether we continue with that investment. Of course, there are risks and scenarios in which that would play out if that deal didn't go through. But at the same time, when the world changes overnight, you really have to think if something still stands. Now, in this case, I think all investors were still extremely bullish on the investment case, still very bullish on the founder, and saw that industry as being an opportunity to endure. And in this specific case, we believe that one of the competitive advantages was that this startup would be cash strapped in such a way that they would possibly outsurvive some of their competitors. And so for some companies, the ability to survive and endure however long this takes might actually be the difference of where they are in the competitive environment. And I always say to startups, like right now, it's not necessarily that the best product or the best solution will win. It's those who can actually just ride this wave out. And so in this instance, we saw that this cash injection was actually going to give this team a real competitive advantage that is even more important right now. So yeah, that investment went through. Me personally, on my investment thesis, the one thing that has just changed is that a big area in which some of my previous investments have fallen has been in live experiences and live events, because that is part of my background. And so I've made investments in Tixel and Muso and companies like that. Now, I'm still very bullish on those companies. Those teams and those founders are doing a phenomenal job at managing through this crisis and leading their teams through. And I have every reason to believe that they're going to be better, stronger, more competitive companies on the other side. But I feel like my investment in the live event space might just slow down for a while we see how this whole thing plays out.
Yes, so Ariane, you're also in the position that you've been vetting deals and seeing startups approach scale networks. What are your views on where we're at, and what have you seen in the process of looking at startups the last few weeks?
Yeah, so just to be very direct and answer the question whether to invest or not to invest, the short answer is absolutely yes. While the environment has changed, and I agree with all the color that everyone's put forward, and you'll appreciate from my background that the way we look at this at Scale Investors is that there's never been a more important time to be supporting female founders. We do see some phenomenal output and some phenomenal companies being led by women throughout this period, as well as throughout the period that since Scale was founded 7 years ago. So our investment thematic has never been stronger. We also have got great engagement across our whole network of investors. So while we've gone completely virtual, there is a really strong engagement. We're actually getting more people attending online events than they may have on average been attending in-person events because of logistics. So we're learning a lot more about our investor base, the high net wealth, sophisticated investor profile. And the fact that people can now do events virtually, meet online, we do the DD behind the scenes, we help bring the investors on the journey. There's some great companies that have been already, and to Rachel's point, the pipeline continues to be strong, and these deals don't happen within a 1 month time frame. These are typically deals that take a minimum of 6 to 8 weeks to 3 months. And again, it's an alternative asset class. So these investments are investments that you want to be holding for at least 3 to 5 up to 10 years, depending on the full journey. So from a risk-weighted perspective, when you take a big step back and you use portfolio theory to consider where does angel investing and alternative assets fit within your investment spectrum, it is a liquid asset that you're going to invest in, and you need to make sure that your price point is the right price point. I agree wholeheartedly that we need to support founders through this period. Our sense from our network and the feedback that we've been getting over the recent weeks is that there is dry powder there. Obviously, there's a motivation to support the existing portfolio companies to ensure that they have that runway and that they make it through the period. But absolutely yes, invest. It's my job. I love it. We're good at it at Scale. We all invest our time, our money. We invest in companies as well as investing in others. So it makes complete sense that angels would rise to the occasion in this current environment and help to continue to activate capital while providing in-kind support.
Thanks, Ariane. That's really interesting. And Quentin, I'm interested in your views. Are you currently vetting deals? And if you are, what should you be looking for from startups at this time?
It's two very good questions. No, I'm definitely vetting deals, looking at whatever comes. I mean, otherwise you just miss out on great deals if you're not looking at them. So there's always still, you know, companies that are going to start, or companies that have started, and it's just they've been caught out by timing, and maybe their business is going to be is fundamentally sound long term anyway. But what should we be looking at? Look at businesses that aren't just riding a sudden wave and have a future beyond this current crisis. So you know, the investment thesis is a long-term investment thesis based on sort of macro trends rather than, you know, short-term trends. What else? Look for great teams as always. I mean, just the fundamentals that you're always looking for: great teams, good product, long-term thesis on or growth tailwind for them, and also a sizable market. But I think more important right now is, you know, can they survive? Does the team have the grit to get through the period now, and enough capital to get through now? Because it would be tragic to back a really good team and them to just not make it through this current crisis. So that's sort of the things I'm looking at.
Fantastic. And Ed, I'm going to throw the same question to you. Are you vetting deals? But I'm also going to ask you, has your sectoral focus changed? Rachel touched on this with events. Are you looking at startups in a different way?
Yeah, so we're still looking at a lot of companies, and we've probably ramped it up just because of the opportunity of the next kind of month ahead. Actually, there's a couple of Silicon Valley investors I kind of follow and who've been in the game quite a while, and a lot of them commented that, you know, 2008 to 2010 was when they did their like best deals, just because the really ambitious founders just weren't fazed by what was going on, and the valuations were really reasonable. And, you know, if it did kind of go south by the time it did, when things started to pick back up, big companies, you know, were wanting to do acqui-hires and kind of wanting to get people. So it was like a pretty good kind of safety net. So yeah, we're quite bullish on looking at deals right now. In terms of focus, yeah, there's definitely a few that have come through where just given the COVID restrictions, it's just not their time. And so the advice I've kind of given them is try and weather the storm and kind of work on parts you can that set you up to kind of go like guns blazing when things do pick back up, or see if there is a pivot in the short term where you can kind of bring in some money, or just, you know, keep things going now to kind of weather that storm. There's definitely, obviously, you know, remote work and online learning and some of these other areas are really valuable right now. So some of those companies are definitely thriving and need more funds. And so we've been kind of trying to hunt down those kind of a lot more. And yeah, in terms of deals, still keeping a pretty, I guess, wide net. Based on kind of what's out there, because yeah, there's a lot of different stuff in Australia that people are great at here.
So thank you, and keep the questions coming. Just a reminder to everyone that's attending, put the questions into the Q&A chat, and as opposed to the chat, and I'll do my best to moderate them. And one of the questions that is sort of, there's a theme coming through, is valuations. And Ariane, you touched on this before. I think I'm interested to get your views on what you think are happening to valuations, and how do you think startups should go about valuing their companies when they're approaching investors?
Yeah, it's a really good question, and thanks to everyone for sending those through. At the end of the day, we all recognize that angel investing, venture capital valuations are more of an art than a science. What we like to do at scale is we run about 3 to 4 different valuation models, but ultimately it's about that discussion with the founder. And it hasn't been lost on us that over recent years, valuations have definitely been creeping up. You know, most engagements we have with founders in the last year prior to COVID, the founders were coming in saying, my company's worth $10 million, and they are pre-revenue. And you sort of think, well, gosh, that's a really big chasm to breach, and how are we going to facilitate that? So I think it all comes back to those respectful relationships, and again, relying on technicals. So, you know, we find it's very helpful to educate not only investors, but also founders on the approach and the valuation methodologies, just to give insight to how we do approach valuation, because it's not just pulling a number out of the air and saying, well, somebody else told me this is how much I'm worth, or this is how you need to look at how much money does the company need to get through X amount of period. Often Australian startups don't raise enough, and that's because they don't want to be overly diluted. So again, having that sort of respectful conversation to educate and inform about how valuation work, how it translates into a proper cap table. So you're not taking too much of the company, you're not under investing at the same time, and you're helping secure that capital for the founder to be able to see through a very important growth phase, because you don't want them limping along and you don't want them over capitalizing and then not working really hard to help deliver on some key strategic metrics. So usually we try and fund companies for a minimum of 12 months. Sometimes they only get enough for 6 months, but it's really crucial that that's in our opinion. And valuations, again, you can do your discounted cash flows, you can do your multiples on earnings, you can do your Berkus method. All of these methods are in the public domain. I saw that Remco, you're on the line, and Standard Ledger's got some great tools for people who want to understand more about startup maths. So really just inform yourself, and really happy for people to come along to Scale and have a chat about how that all plays out.
Thank you. And Quentin, do you have anything to add on valuations? Otherwise, I've got another question for you.
I will add that valuations will come down. That is most likely, especially for companies, as Ariane said before, that were coming in with 9 to 10 million vals based on no revenue. So that's what I would say about that, but I'm happy to take another question from you, Kate, as well.
Well, I was going to do a shout out to the VC Catalyst. It's a program that's funded by LaunchVic. Rachel has been absolutely instrumental in getting that off the ground, and I think a number of people are joining from VC Catalyst today. And that's really a program to help investors upskill. Scale Angels has also been supported to do a program to help angels upskill. So what we know is that we've got several angels on the line that may be thinking, maybe early stage, they're early in their career as an angel investor. What are the red flags that you would advise those angels that are new to the game that they should be looking out for at this time? Is that the same red flags as existed 6 months ago? In which case, what were they? But what are any additional red flags that they should be looking out for?
Additional red flags. I think maybe, as I was saying before, one additional red flag might be that a business that's entirely based upon the current conditions in terms of it's trying to ride a wave, but come the end of this crisis or towards the end of it, that the business may not exist anymore. Another one would be a business that probably won't exist at the end of this, not because it's riding a wave, just because the conditions and the social behavior that we are now exhibiting will probably become less prominent in the future. So trying to think through this crisis, knowing that it's probably somewhere 12 to maybe 18 to 24 months, from resuming maybe some level of what we call normality. Trying to think forward and think about the business and what it would look like in the future. I think that's sort of key to thinking through whether a business is still going to be around. I think going back to what had traditionally been red flags are founders that oversell, in my opinion. I mean, they have to be good sellers, but they have to be realistic and know where they sit in an ecosystem in terms of being realistic about achievements. Everyone who's got the whole company planned out for 10 years in terms of financials and so on like that, and projections, they're probably not in touch with reality right now. Everyone knows that projections are pretty much worthless, and it's more about the team and their ability to execute. So I would be looking for signs that they have some sort of connection to the industry or the problem that they're solving. Those who come in from a completely different space without another team member or someone that has some sort of connection probably aren't going to know the nuances in that industry and how a consumer in that industry thinks. So that would be another thing. anyone who's, and this popped up on Twitter, and I've chatted to the angel about this, but anyone who's particularly argumentative with you and trying to browbeat you into an investment is a massive red flag, because they're probably going to do the same with customers. And I don't think anyone's ever invested after being harassed by a founder. So those are just a couple of things that I would look for. Just on an angel side of things, I think what you also have to look for that's not external but that's internal is a gut sense of whether you believe this person and whether you think their plan and their business is credible. I think that's more important, because essentially for new angel investors, the money that they are going to invest it's at risk, right? It's a really high risk asset class, and they need to feel comfortable that if they do lose that money, they've backed a founder and it hasn't worked out for some reason. They don't want to go and invest that money and feel like they've been swindled or they've invested into a bad idea, because they need to know that there's a high chance that they may never see that money again. So those are just a few things from the external source, but about an internal sense of investing as well.
Fantastic.
Sorry if I rambled on a bit.
No, very, very good advice. Rachel, I'm going to throw to you, and I'm going to pick up one of the questions that come through the Q&A channel as well, which went to, maybe not I'm paraphrasing a question, but maybe not raising as much money as you wanted to, and the risk of them bringing on more investors. And how do you manage cap tables in this environment? And what are some of the things that we should be looking out for if you are an investor and you're then seeing lots of pots of money, smaller pots of money come forward? How should you handle that as an investor?
So there's, I think, a few things wrapped up in that question. I'll start by saying that right now, if you are a startup that relies on external capital in order for you to grow and scale, launch your product to market, or have a competitive advantage, then right now you should be trying to grab as much cash as possible, and grab as much cash as possible. And so that means that you might have to forego, it depends on who your investors are, but it might mean that terms will be slightly different. As was discussed, it might mean that valuations might be slightly different. And it might mean that you'll have party rounds, whereas before you probably would have preferred to just have a few people. I think that we're going to look back at this time, and a lot of kind of misgivings are going to be forgiven. Right. And so there are many investments that I make where we have to do a bit of cap table cleanup. And so I think a lot of early stage investors kind of know and have a tolerance for that. And I think in 2 or 3 years time, when follow-on investment rounds are happening, if there needs to be a little bit of cap table cleanup that happened during this time, I think that there will be an understanding of that. I think that, founders should still be conscientious of how much of the company they're giving up. I still think like the standard dilution per round should roughly be right. But again, you'll be taking the money at slightly different terms. I think that right now the important thing is that in the past, when I invested in a round, I expected that money to last somewhere between 9 and 12 months. And right now, if I'm making an investment, realistically, I have to believe that either that cash or revenue that's going to come from that cash is probably going to last them to December 2021. And that's kind of a worst case scenario, but I think that's kind of the scenario planning that a lot of investors are thinking through. And that is where, that bar of what's investable is changing, because we need that cash to weather this storm if it is going to be as long as we might fear it to be. Just a quick note on valuations, because I just want to chime in. Where I think valuations won't necessarily change is kind of that first round, like that super, super early money. I usually do that. I kind of triangulate, and it's kind of like, hey, how much money do you think you need? And again, that amount is going to be different based on the runway. How much do you think you need in order to get that like real step change in your business? What percentage of the company are you willing to give? And you do the math and you kind of figure out the val. Where I'm seeing a lot of valuation compression is in follow-on rounds. And what I'm seeing in that kind of spirit of a lot of people advising startups, like take the cash, whatever you can get your hands on right now, is that we're seeing some lower valuations or some flat rounds. So to get very specific, there's a company in my portfolio that's amazing, outstanding company. And they were going to market in this round with lots of interest at a 20 mil val. In the current environment, they're likely going to do something closer to the last round, which was 7 mil val. And it basically means that all the work over the last 12 months kind of disappears, right? All that like amazing traction and revenue and customer engagement that they've created won't be represented in this round. That said, they need that cash to survive, and that growth and progress isn't lost. When we are out the other side, we'll be able to account for it in the next round. So I'm seeing the valuation compression happen in those follow-on rounds, not necessarily those first rounds.
So Ed, I'm going to throw to you and see if you have anything you'd like to add on valuation, but also to pick up on Rachel's point. Angels, where is the opportunity in the market? Is it the first off deals? Is it the really, really early stage that they're doing their first round, or is it later round? Are you looking at both? Where do you see the deals, and excluding your follow-on investments? So.
I think you raised some great points there, Kate. What I've seen done that a lot of people kind of haven't really talked about is people that can be really helpful to a business. And then instead of, maybe in an early round where they're raising like 250K or something, putting in maybe like 30 or 50K, they do it alongside a much bigger round. Or I've seen the startup itself kind of make an entity where they bundle up a lot of smaller investors to all be in kind of one entity that's only going to have one name on the cap table, and basically getting these people that could be super valuable to the kind of business, and just giving them a way to kind of contribute and justify kind of putting all this effort in. And that way, if you're the angel, you might not get kind of as much a return, but the deal is like a lot safer. You're following kind of existing people, and that's a really popular kind of approach that I've kind of seen in the US, especially with all the syndicates that goes on that's led by funds or led by kind of super angels. In terms of valuations, yeah, definitely seeing drops, and definitely, there's so many different ways to cut these things. And what I see with startups is either they go out to market and they don't get any offers, they go out to market and they get one offer, and then it's pretty hard to negotiate. And then occasionally you get them where they get, quite a few. And that's where you can, even in a market like this, still get a val that just doesn't seem kind of justifiable or seems pretty juicy given the kind of climate. I've seen a couple of deals like that in the past few months. And, the really solid businesses that aren't fazed by this, like, can still kind of get away with that. And then back to one of the points we had earlier around the kind of market sentiment. Because most people are going to get told no and their businesses aren't going to raise. And, a lot of people might only do like one to a handful of deals a year. Of course, most people are going to be walking away feeling, unsatisfied with how their fundraising experience was, which is going to create, a lot of kind of noise in the market of people not investing. And, if you're a founder and everything's really like tough and you can't get funding away, it's a lot easier to kind of, be able to like blame it on the market. And, when I used to be in the US, tons of Aussies would come over and, it would always be, most of these investors just won't do Australian companies. And then, some of them started asking, like, ignoring the Australian thing, what are the problems with my business? And they'd still get, all these like great answers of kind of where they were at and where they needed to be. And so, look, it's definitely tough out there as a founder, and you got to roll the dice and you got to, swing for the fences and try and raise a round. But, I was trying to think of where are you at now? What's the feedback you're getting? And just trying to call a spade a spade.
Excellent, thank you. So good advice there. So we've got a number of startups on the line, and I know we've been focusing a little bit more on whether investors should invest or not, but I'm also really conscious of our startup community that are listening in. What's the difference between pitching online and pitching face-to-face? And I'm going to throw that to Quentin. We were having a chat before we joined in the call around some of your experiences. But what are the tips that you'd give to startups that are listening in that are having to approach investors for the first time online? How should they go about that?
One thing I would definitely do is I would research the investor. A lot of people like to contact you randomly, and that doesn't always go well with a lot of investors because they get a lot of cold contacts or emails and so on. So one thing I would definitely do is research the investors and work out how you think, if they're a really good fit for the company, how they can really add value to your company. And in that way, I think having a conversation online is a lot easier, because you can certainly understand what their strengths are, what their experience is, and you can find common ground really early. Online versus face-to-face is quite difficult. I think a lot of people prefer face-to-face meetings. I think that's come up a lot recently in terms of people are missing it. Apart from just missing good coffee, they're also missing that sort of close contact with people. And if you can find common ground with someone really quickly on a call, I think your call is going to be a lot better, and you're going to get a lot more rapport with those people. And early stage investing is a lot about building a rapport with investors, from my experience. You'll be able to convince them a lot more easily to invest in your company. I mean, you're not going to brainwash them, but you'll be able to build that rapport and convince them to invest. So I think that makes fundraising a lot easier. They're more likely going to want to help you when you need help. They're also more likely to be a sympathetic ear when you need it, and they're going to open up their networks. So doesn't matter whether it's a startup or from my side as an investor, or whether you're a startup talking to an investor, really do your research on the other people and know how you can sort of build common ground with them. Does that answer your
Absolutely.
question, Kate?
And I'm going to throw to Rachel now, because the other thing we love to see as an investors is customer traction. And, getting customer traction in this environment is really hard for startups. So as an investor, what do you think, if you are going to look at deals, how are you going to be looking at customer traction, and what advice would you be giving to startups in having discussions with potential customers?
Yeah, I think the fundamentals remain. So, I think that if you can't get traction in this environment, it doesn't bode well in the event that this is a protracted situation rather than a short V-curve one. And I actually think there's some advantages right now. I think that your customers are more available than they ever have been. I think now is the time actually to pick up the phone or jump on a Zoom and really get to know your potential customers, intimately understand those customer pain points. And if right now this isn't the time for you to land the sale, this is the time for hardcore customer discovery and convert that into your product roadmap. So for some of my companies where kind of customer acquisition is going to slow down, this is when they have an opportunity to really focus on that product and build kind of while the lights are out, so that when the lights flick back on, they have a product that is, ready to go and like deeply embedded in real customer pain points. So yeah, I think that a lot of the fundamentals haven't changed, but maybe the order of operations or how deeply you can go with customers has actually improved right now. I think that, chances are your customers are suffering in many different ways through this time. And so if you have a product that's alleviating a real pain point for them, then they're going to want to engage with you. They're going to want to be part of that solution. And I think that there's probably a greater willingness to kind of experiment alongside you, in some instances. The one thing I just wanted to add to Quentin's point is I agree in that so much of my investment in the past has been around rapport that I built with founders. I'm a little bit grateful that I have this barrier now between kind of what was the coffee chat and now is the Zoom screen, in that it forces me to protect against some biases that I think were creeping in. So sometimes when we sit down and we really like someone, especially if they remind us of ourselves, we have some cognitive biases that empirically have shown to not necessarily be very good investment decisions. So I think that when I think it's still important for you to have a deep belief in that founder, in her or his team, and the problem that they're solving and the size of that market. I think that a little bit more discipline where I'm looking at some fundamentals rather than vibes, I think is going to be a net benefit to my investment decision making.
So Ed, I'm going to throw one that's come through the channel to you on crowd equity platforms. What do you think of the role of equity crowdfunding versus angel investing over the next year? Are we going to see an increase in equity crowdfunding platforms, or do you think the angel community is going to sustain those early stage investments?
That's a great question. I think just just as some angels are stepping away, given the current climate, I think there's probably some people that use those crowd platforms that will be stepping away as well. At the same time, there'll be some people that, you know, are positioned to weather the storm and do want to use those funds. What I have noticed is a lot of founders kind of do prefer just to be able to, it's a lot easier to just raise from one person and just have them to deal with versus opening up your business to, you know, all these different people that now kind of own a share in you, and you have to be accountable to them. I think going down one of those platforms, you know, has its like pros and its cons. So like, you know, there's a lot of businesses that have done Kickstarter, and then of course people in China see it and start working on it at the same time. At the same time, you know, going on Kickstarter and getting, you know, getting all this attention from your product, or going on one of the local platforms in Australia now that the rules changed a couple of years ago. It's certainly a powerful way to access a lot of capital, to get a lot of attention and get your product kind of awareness in a lot of people's minds. So I think, you know, all those platforms, you know, I just hope that they can weather the storm and that people are still doing deals. And if you're a founder and you need money and you're passionate about that business, you should definitely, you know, explore all of your opportunities and have that as one of the options. What I would say is, you know, when you see a deal and it's, you know, it's gone to the VCs and it's gone to like some of the small ones and it's gone to some angels, and then it's on like one or more of the platforms, the more people kind of start to see it all over the place, the less kind of exclusive it feels. And then it does become harder to kind of get the round away. And just jumping back to kind of the traction piece people were talking about before, and kind of first time angel investing. One of the things I've noticed is people that are new to investing, you know, they come in, they're looking for all the right things, and they've done some training, or they've read some great books, and they've had some good chats. They see a business and then they get really excited about it because of the numbers, but that business has been around for, say, like maybe 3 to 5 years, where there are other businesses out there that've got the same traction in like 6 months to kind of 18 months. And so just knowing like what the velocity is and kind of how long the deal's been around, I think is super important if you are going to kind of put money in.
Great advice. Rachel, do you have anything? You look like you were about to say something or wanting to say something there. No? All good. So I am going to pull another question out the channel, and so I'll throw to Rachel. Do you think things will go back to normal, or are we going to shift dramatically? Is there a new normal that's coming us, and should we be thinking about how we're going to angel invest differently into the future?
Listen, you know, they say, you know, man plans, God laughs. I think it's really hard for us to predict the future. I think the best thing that we can do right now is scenario plan, think about what we as investors have strong convictions on, and where those convictions line up with things that feel like somewhat of either inevitabilities or things that are unlikely to change. And we're going to get it wrong, right? Sometimes we're going to get it right, and sometimes we're going to get it wrong. And when we get it right, we're going to think we're brilliant. And when we get it wrong, we're going to think that it was, you know, something else happened. But this is why, you know, my theory of angel investing is that you have to have a really large and diverse portfolio. So the way that I manage risk during this time is not by acknowledging that I can't predict the future. And even in good times, you cannot predict which companies are going to go boom and which are going to go bust. And so the way that you manage against that is you try and play the numbers game. And, you know, you believe wholeheartedly in every single deal, but you get a lot of them. And you know that you just need 1 or 2% of them to return the fund. This is not, you know, looking for every investment to go well. And I think that, you know, those fundamentals remain regardless. As far as the new normal goes, I definitely think that we're going to come out of this as a society very different. And I think we're going to come out, you know, as different investors. I certainly see the world differently. I see, you know, my family differently. I see my kids' future differently. And I think that some things that will return to normal, it's just going to take a while. I think we're going to be surprised at how some of this crisis has personally impacted us, and that it might take some time for us to get back to it. And then some things I think will never be the same. And I think that will be, those will be good things that change. What I also believe is that this is not going to be a light switch. It's not going to be, we are here in crisis and then we flick the light switch like my lights went out before and all of a sudden we are back to normal. I actually think this is going to be a bit of a roller coaster. I think that things are going to get better and then they might get worse and they might get better. And so our new normal is actually going to be ideally being able to have resilience and capability and flexibility to ride some of those waves, which is great for startups, right? Because amazing startup founders know how to ride those roller coasters. They know how to, be flexible, how to react very quickly to changing environments, which is why I'm continuing. I think this sector is gonna pull us out, and into the future. But I think we're in for a ride.
So Quentin, I'd like to get your views. If you had a crystal ball, where do you think we're going to be in a year from now? Oh, you're muted.
Sorry. In a year from now, I think we're going to be coming out of this. It's really going to depend on the economic crisis and how long that lasts. I would slightly take a different view to Rachel. I think we will go back to mostly normal because human behavior sort of reverts to type eventually. So this will just be another cycle of crisis that we always go through periodically, whether it be financial or health. But I do agree it'll be lumpy for a while. But I think by this time next year, we'll be starting to emerge out of the health crisis, hopefully, and we will be much more focused on what is the economic effects. And that's really uncertain because no one can predict right now. People talk about V's, U's, W's, all sorts of different type recoveries or depressions or whatever might happen, recessions. So yeah, that's where I think we'll be going. One thing I just forgot to say before, and I think it's really important, it goes to Ed's point in terms of investing, is that having experienced investors around you, either on the company side or on the angel side, is a really good guide for investing. And that doesn't necessarily happen on those platforms. It might happen in whether it be syndicates or groups of investors. So that's one thing to look out for, and taking their cue would be a really important guide for whether a deal has been floating around for a long time or not. So two things in one there, Kate. Sorry, I sort of diverged a little bit.
That's good. Ariane, I'm going to say the same thing to you, but where do you think we're going to be in 3 years' time? And do you think we're going to see a revival of some sectors that perhaps haven't been as important to our startup landscape over the last little while? I'm thinking specifically of the likes of manufacturing, etc., where we're seeing a change in some early signs of a changing political landscape. Do you think, what's your response? Where do you think we'll be in 3 years' time?
Sure. So 3 years is a long time, clearly. And I would like to think that through this period, we will learn and be better informed about ongoing risk assessments. One of the things that really strikes me about this asset class in the early stage investing space is that, we're not recreating the wheel every time. And if we can leverage our networks, and Scale does a really good job of this, and investing aligned with skills, experiences, and backgrounds where people can add value into companies. We've invested in some phenomenal businesses, which is property. We've got property. People who know everything there is to know about property are investing in innovative companies who are changing the landscape of property and urban planning. We've also invested in companies like Talkie Play that are fundamentally changing the way kids learn how to talk. We're investing in companies like Handy, which are fundamentally changing the back office systems of insurance companies, which are hugely legacy driven, broken, fragmented, cost millions of dollars to support, and nobody's had the confidence in the CTO function to actually rip the Band-Aid off and spend the money to replace the system. So that's all going to be playing out over the next several years, in my opinion. If there was ever a time for companies to be showing leadership, listed companies as well as unlisted companies to be showing real leadership, and thinking really strategically about how to allocate that investment, this is it. And to answer your point around 3 years from now, what I would love to see is a very different ASX top 50 companies, which are companies that are not relying on the mining and bank yield driven revenue stream for what has been going on for decades in this country, which is not a criticism at all. It's just that our economy is fundamentally shifting, and I feel like we've been on the back foot And this is an opportunity to be on the front foot. So I'll reiterate my core message, which is we are cautiously optimistic. There are a number of opportunities. I think we will look back to this time in 3 years and say, gosh, those were some great deals that were done. It's really wonderful that those companies were founded when they were, because how big is the graveyard of companies that will exist if we don't make an effort at this time? So that's sort of my view.
Really great point, Ariane, and it's certainly something that I think your point about 50 ASX companies, you look at the US exchange and you see how many of those companies are a tech-driven startup out of the sort of year 2000s kind of era, and yet in Australia that is such a rarity. So there is a real opportunity for our economy to shift. Ed, I'm going to throw to you. Where do you think we're going to be in 3 years' time?
Yeah, similar to what others have said around, I think it'll be a slow kind of rebound. On the manufacturing front, we've got a couple of hardware companies in the portfolio. There's definitely some that are in the US that are now, just because of this COVID thing and a couple of other issues, have been having challenges in China. And they're definitely exploring other countries and also how can things be done locally. And so I think this COVID thing has definitely had a really negative push on the whole globalization and relying on putting everything, sending it all over the world. And I think there'll be a pushback against that. But as long as the pricing kind of can stack up, I think we should see some movements there. I think, look, there's the VC funds that have raised big funds now. They're going to be able to keep investing in the bigger companies for the next 3 years. And so I don't see any problems there. I think there's always good deals no matter the climate. So I think there are going to be some great investments that happen over the next 3 years. Just I'm not sure how many. And obviously, hopefully this call and lots of other initiatives do kind of showcase what's out there in the ecosystem and do get people involved. I think the other thing I'd say is, even if you got the current ecosystem and there is a bit of a downturn, it's still a lot better than what it was, say, 10 years ago. My first startup we did in 2008, we won an international software design competition, and we got some money from Microsoft and a letter from Bill Gates, and we went to Silicon Valley and it was all looking great. And then Lehman collapsed and all these other things happened. And in Australia, we just couldn't find any people and money and resources. And just seeing how big the ecosystem is now in Australia and how many people have kind of done things before and how many people there are that are willing to help and kind of support each other. I think even though there is a downturn, the next 2 years is going to be so much better than what was happening, say, 10 years ago with the GFC.
Yeah, great points. So I have one last question to you all, which I'm just going to ask you to do a thumbs up or a thumbs down. Are you going to keep on investing? So there's still money to be had out there. So I think the summary is that resilience and flexibility is the key right now. There's definitely going to be a motivation amongst investors to keep supporting the existing companies they've backed in behind. But we've heard loud and clear that good founders and good companies will get funded. It may be at a reduced valuation, but those that can ride this wave have an opportunity to win big. And we have got a phenomenal startup sector here. And I can assure you that at LaunchVic, we're spending our time thinking about how we continue to support the sector. We know evidence from previous economic downturns are that entrepreneurship can play a vital role in economic recovery. And we really, truly believe that. And we've certainly heard that from our panelists today. So while we're all going through tough times, I think there is still a bright future ahead of us, albeit a challenging one with some road bumps along the way. But it's fantastic to have Rachel, Ariane, Ed and Quentin bring their knowledge to bear and demonstrate that their angel investment community is active, it's out there, and there are a great bunch of people that are working to support the Victorian startup community and Australian startup community more broadly. So thank you for the panelists, and thank you for everybody else for attending.
Thanks so much, Kate. Thanks, everyone.
Safe.
Thanks, everyone.